Hello and welcome to Infinity Concepts. This is Aadit Shah and we are at the third chapter of Quantitative Methods, which is Statistical Concepts and Market Returns. What are we going to see in this particular chapter? It is Introduction to Statistical Concepts, Measures of Central Tendency, which is Mean, Median, Mode and the Quartiles, Measures of Dispersion, which is Range, Mean Absolute Deviation, which is MAD, not MAD, Standard Deviation, and Variance or Variance, however you spell it out and pronounce. So Variance, Variance, anything, whatever comes to my mind, I will be speaking. Chebyshev's Inequality, Relative Dispersion, which is CV, and Sharp ratio. CV is coefficient of variation. Skewness and kurtosis. So many heavy names in this particular chapter. By the end of this chapter, you will be knowing each and every one of them very clearly. So it's okay. Just remember what we are going to do. And then the last one is risk management. So yes, this is what the chapter is. Third chapter you will feel is very difficult by just seeing at all of these topics. Please, there are a lot of other topics in quants that we are yet to do, which is still more difficult than what we are seeing over here, just by hearing it out. Okay, by the end of this chapter, while we complete this video, you will feel this is a very simple chapter. There was nothing in this particular chapter. But yes, right now, while you have just read these words and skewness, kurtosis, and coefficient of variation, Sharp ratio, MAD, standard deviation, variance, standard deviation, variance, still you would have heard sometime, mean, median, mode, that is also fine. But then other things are a little bit new to us, right? So we will be seeing what all of these are. And don't worry, in future chapters, we'll be seeing more and more difficult things as well. Nothing is going to become difficult by the end, because we are going to learn each and everything in detail, everything. So let us just go ahead with all of these topics. What is the first one? Introduction to statistics. Statistics means what? It means having a large data set which is represented in such a manner so as to analyze it more effectively. Example, when you are using a chart or when you are presenting something in a percentage format. So what happens is that we are able to properly understand what they are trying to say. Say for example, if there are absolute numbers, instead of absolute numbers, if it is converted into percentage format, we exactly understand what are they trying to represent. This is what statistics is. So in statistics, we are going to learn about a population and sample. Population means it is a set of all the possible members of a stated group, that is known as the population. All the stocks traded on New York Stock Exchange or all the stocks traded on Bombay Stock Exchange. So there will be 5,000, 10,000 stocks which are traded on stock exchange. All of that together forms a population. Now out of that population, if you select a few of them in such a manner that it represents the population very effectively, that is known as a sample. You'll have to see to it that it represents very clearly and very well of the population, which is known as a sample. So it is a subset of the population and is made in such a manner to properly represent the population, and therefore a good sample is a one which is properly representing its population. There should not be much deviation amongst them. And therefore, Dow Jones represents the mood of NYSE, Sensex represents the mood of BSE, and so on. So what are all of these? These are indices. These indices are representing the whole market on the Bombay Stock Exchange or on the New York Stock Exchange, and therefore they are known as the sample. Now the sample should be properly represented. It should have equal, or it should properly represent the pharma companies as well as metal companies and infrastructure companies and technological companies and whatever the banking and financial services industry companies. So all of them together, the sample should be such that all of them are getting covered in it. This is what a sample is, and a good sample is going to be appropriately representing the population. Little bit here and there is definitely going to happen because it is not a population and it is just a sample of that, but its representation should be very near to what the population is showing. This is what a good sample is. So your population and sample is over here. Based on that, there is going to be a parameter or a sample statistic. both mean one and the same, but if it is relating to population, we call it as a parameter. If it is something related to statistics of a sample, we call it as a sample statistic. So what are these things? A measure which is used to describe a characteristics of a population, that is known as a population parameter, or simply saying as a parameter. So if, say for example, you are finding out mean, median, mode, standard deviation, variance, mad, range, whatever, if anything that you are calculating which relates to population, then those things will be called as population parameter. Same things, all this variance, standard deviation, mean, median, mode, mad, range, whatever you calculate, Sharp ratio, whatever you do it, if you are doing that for the sample, then those same things will be called as sample statistic. It is a measure used to describe the characteristics of a sample. So same standard deviation will be used as a parameter as well as a sample statistic. If the base data that you are using is of a population, then that standard deviation will be a population parameter. If the base data that you are using is from a sample, and from that if you are calculating the standard deviation, then we will call that that standard deviation as sample statistic. So both means one and the same only. Just what by meaning of what we are saying, you will understand whether it relates to population or it relates to sample. So that is your parameter and sample statistic. Both actually means one and the same only. The only thing is the base data is one of a population and the other of a sample. Let us move ahead. Frequency distribution and histogram. So how are we going to distribute the frequency and the histogram? So data is distributed and presented in a tally format. Over here we can see tallies. There will be range of returns. Say for example, returns have been for a particular stock. So every year the stock would have returned some amount. The return would be between minus 30 to minus 20%, minus 20 to minus 10%, minus 10 to 0%, 0 to 10, 20, 30, 40, and so on. There will be different buckets, and in those many years, how many times the returns have been given in years. Say for example, in 1976, once the return would have been between minus 20 and 30. In 1980 and 1993, two times the returns would have been like this. Then three times, maybe some other 3 years, the returns would be between 10 to minus 10 to 0%, and so on. This is how frequency will be distributed. So this is how you do tally. Most of the times the return has been between 0 to 10%, which is 7%. Absolute frequency is like that. How do you write tally? You can either do like this, or some people also use 1, 2, 3, 4, and for 5 like this. 1, 2, 3, 4, 5 like this. 1, 2, 3. So immediately you can, just by looking at the picture, you can come to know that, okay, this is 13 actually. So a bunch of 5, 5 and then 3 together. So you only have to count this as 1, this as 2, and there are 3, 1, 2 and 3 over here. So 1 is representing 5. So there are 10 and then 3 together. So this is how you do your tally as well. And once you have got this frequency distribution, then you can prepare a histogram for that. So in minus 30 to minus 20%, there is 1, then there is 2 in the next 10, then 3, then 7, then 3. This is how a histogram is prepared. There will be 1 over here, then there will be 2 over here, then there will be 3 over here, then 7, then again 3. This is how a histogram is prepared. You come to know that, okay, most of the times the return has been between 0 to 10%. This is known as the modal interval. So here 0 to 10% interval is the highest tally, and therefore it is known as the modal interval. A graphical representation that we saw right now of absolute frequency distribution is known as histogram. So this is what we saw over here is a histogram. This is how your frequency distribution is done and the histogram is done. All of this is known as statistics because it is easily interpreting the results, the data. So the data which is too humongous easily gets represented over here on a histogram or over here in the frequency distribution. This is what statistics is. We will move ahead. Now coming to measures of central tendency. Now, before we go into deep inside this particular chapter, let me give you a small brief as to what we are going to do. What we are right now going to do is, say for example, just very briefly, okay, we are just going to touch a few points very briefly. Say for example, my company has done portfolio management since years, and say for example, returns of past 10 years have been 22%, 14%, 3%, 14%, -5%, 26%, and so on for 10 years. For 10 years, I have been doing business and I am in this particular portfolio management services. And for my clients, I have achieved a return of these percentages for past 10 years. Now, if I want to know what is the average return that I have actually earned over the period of last 10 years, or if I want to know if these are the returns of past 10 years, then most probably on an average basis, what would be my return next year on the 11th year? I want to just forecast, just to know as to what may be, in what range. Have I ever given a return of 65% or 70%, or have I ever given a return of -50%? Like I would have just made the my clients money half if my return would have been -50% any particular year. So just want to know what would be the average at any given point of time. So the average that you calculate is known as measures of central tendency. The word itself in this sentence, measures of central tendency, the word itself is having something known as central, which means you are trying to find out whatever the midpoint or the center or the average amount is. Out of all of these 10, when I take a normal simple average, say for example, I come to 15% as the average of all the 10 years that I have taken. It means that the measure of central tendency is 15%, which means on an average, most probably my portfolio management service, the client's money is going to grow by 15% on an average. Now, in reality, it may not be true. In reality, next year we will see what am I able to achieve. Maybe I can achieve 20%, or I can achieve 5%, or just see, once I have also gone into negative, minus, I have gone negative, and also once I have got super positive 26%. Anything can happen. So technically, we are not sure that, okay, this is the average, so next year 15% is only going to happen. No, that's not sure. But we have just tried to get what the central tendency, what the average is. That is known as measures of central tendency, and through different methods, we will find that midpoint or the center point or the average. Just to be very clear, it's just the average. So there are different things. We will be seeing mean, median, mode. Within mean there are going to be different harmonic mean, geometric mean, arithmetic mean, and so on. So different things we will see. All of them, they are going to give you that one particular return or one particular amount, which is the average amount or central amount or a midpoint somewhere. This is known as measures of central tendency. Now, going ahead, then later on in this chapter itself, what are we going to learn? We are going to learn dispersion, measures of dispersion, which means now I have already calculated that my average is 15%. But you know, in reality, it is not going to be 15% exact. Exact 15%, the chances are next to impossible. It can be 16%, 14.5%, 14.9%. But what is the probability of having exact 15%, the average that I have just calculated on calculator right now? That's negligible. And therefore, what in reality will happen is you may get your return something in the range of 10% to 25%. There are chances that your return will be between 10 to 25% or 10 to 20%, like 15% is the midpoint. The range that you are having is between -5% to 26%. Like this is the maximum I have gone. One fine year in 2020, when there was COVID, my returns were -5%. And then when there was recovery in the latter half of 2020, my returns were 26%. So this is the maximum range. Now next year should be between these two, right? It is not that the economy is going to falter completely. So next year may be between these two. So range is something which is a measure of dispersion as to you have calculated 15% as the average, but now how much are you going to move, maybe ahead or behind the average. 15% is the average that you have taken, but in reality 15% is not going to be achieved. Maybe you will be achieving something more, or maybe you would be achieving something less. So how much is the deviation that is going to happen? So it is going to be between 25% and maybe 8%. This is the range between this you are going to move. That is going to be your standard deviation, that is going to be your variance, that is going to be mean average deviation, or a range. So over here I have shown simplistically range, that your return are going to be between 8 and 25%. Most probably what the average is 15%. But 15% is just the average. In reality, it will be between a range. How can you say with surety that it will exactly be 15% only? No, that's not possible. And therefore, we give measures of dispersion. The deviation that may happen, that is what your standard deviation is. So standard deviation may be over here 7% would be there, like plus and minus 7% is happening, or 10% is happening. Whatever the standard deviation is, that we will calculate what it is. But this is what we are able to see. This is the range 8% to 25%. This is the MAD, which is mean absolute deviation, standard deviation, variance. This is what is your measures of dispersion or the deviation that is happening. And then in the end, we will be doing relative dispersion. A relative dispersion is when you are having two products, both of them are having their own means and their own dispersion. Their means and their dispersion, say for example, both are having their mean and standard deviation, mean and standard deviation. When both of them are having their own mean and standard deviation, then you cannot compare both of them together, because apple to apple comparison is not there. One would be having a different mean and a standard deviation. This would be having a different mean and therefore a standard deviation. And therefore both, if you want to compare, you will have to compare on a relative basis, relative to its benchmark, whichever the benchmark you have considered. So that is the Sharpe ratio, coefficient of variation. These are the two things that we will be learning. So that is your relative dispersion. The only thing I want to make out over here is there are two things that we are going to learn in detail, is the measures of central tendency, which is first finding out how this 15 is coming up, how this 15% came, that is the measure of central tendency. After you have done measures of central tendency, then you will find out how much in reality it may go up or down. So this is your measure of dispersion. It may be between 8% to 25%. Now in reality it may fall within 8 to 25%. Okay, 90%, 95%, 99% chances are that my returns will be between 8 to 25%. This is the measure of dispersion that I have done, and I have calculated that most probably my returns have majorly been between 8% and 25% only. And through statistically we have found out these two ranges, 8% and 25%. But yet in reality anything can happen. I am extremely fortunate. My stars are, I'm very lucky. I'm extremely fortunate and I could achieve a return of 45%. Now, will I say no, that no, my range was only between 8 to 25%, let me make some losses? No, if I have gained 45%, I have gained it. So in reality, anything can happen. We don't say that, okay, measure of dispersion is the final one and the return should be between this range only. No, that's not possible. That's not a fact as well. But we say with some reliability that, okay, you have calculated 8 to 25%. Most probably within this range or within this dispersion, your returns are going to be there. This is what the brief that I have given you. Now we will calculate each and everything, like how this 8% and 25% has come, the measure of dispersion that we have seen, the standard deviation that we are going to calculate, the variance that we are going to calculate, the mean average deviation that we are going to calculate, and how this 15 came. For that 15, which is measure of central tendency, we will be doing mean, median, mode, and all of these things. Fine. So let us first move on with measures of central tendency, means finding out how this 15% has come. Identify the average or the midpoint or the center point of the whole data set. The data set can be either a population or a sample, whatever it is. So if say for example you are finding out about all the stocks on Bombay Stock Exchange, then that is the population that you are calculating. You are going to find out mean, median, mode of that. Or else if you take out a sample of that, say for example about Sensex or Nifty, you just take about those 30 to 50 stocks, which is the sample. No doubt the sample is actually a good sample representing the population only, but yet it is not the population. It is a sample only after all, and therefore some difference is definitely going to happen. If you find the mean of the population and mean of the sample, it will take time to calculate mean of the population, which is too large. But now if you are calculating the mean uh, of the sample, then it will definitely be a little bit different, even though we have tried our best to have a good sample which represents population, but some differences anyway is going to be there always, right? So let us see, whatever we are doing, the formula is not going to change. Whether the data set is a population or a sample, the formula over here is not going to change. So let us understand what measures of central tendency are. The three methods that we are seeing over here, mean, median and mode, these are the three things that we are going to learn. Mean is further divided into three parts: arithmetic mean, geometric mean and harmonic mean. These are the three methods of calculating mean. These are different types of mean, okay? These are not just methods, these are different types of mean only. Arithmetic mean, which is what we are going to learn a lot, and then geometric mean, then harmonic mean, and then we are having median and mode. So first, understanding what arithmetic mean is. A simple arithmetic mean is summation of all the values, summation of x divided by n, summation of all the values divided by count of the values. We will be taking example of all of them. So we will be having example of simple arithmetic mean, weighted average arithmetic mean, uh, of geometric mean, harmonic mean, median, mode. We are having on everything, okay? We are going to have some sums on all of them. First is the simple arithmetic mean. What is a simple arithmetic mean? A simple arithmetic mean is summation of x divided by n. So summation of all the values divided by count of all the values. And weighted arithmetic mean, a weighted arithmetic mean is summation of weights multiplied by the value. So whatever the weight of that value is, so that plus the next weight into value plus the next weight into value. This is what your summation w into x is. So you will have to calculate the weight 1 into what is the value of that 1 plus weight 2 plus value of that 2. And likewise, if there is a third one and so on, you will have to go on. This is your weighted arithmetic mean. So arithmetic mean is very simple. The next one comes the geometric mean. Geometric mean is all the values that you are going to take, multiply all the values and to the power 1 by n. So if there are 4 values that you have taken, so say for example 6 into 4 into 3 into 9, these are the 4 values, to the power 1 by 4 is what you are going to do. So this is the fourth root of all of these 4 things. So this is your geometric mean. And remember, geometric mean is usually used when you are having previous year's returns. Okay, this is the return that I have generated, 1.06. Say for example 6% is the return, 4% is the return, 3% is the return and 9% is the return. Then how am I going to calculate the geometric mean? It will be 1.06 into 1.04 into 1.03 into 1.09 to the power 1 by 4. When you do this, you will come to a figure which is, say for example 1.041. This 1.041 is your geometric mean. This is the average return that I have actually got over the period of last 4 years. You do minus 1 and therefore you get 4.1 percentage. This is my average return that I have earned in last 4 years. So geometric mean is usually calculated when you want to find out what is the return you have actually earned in last 4 years. And this simple and weighted arithmetic mean you will be calculating when you want to get an average number, because average is something that we are going to associate it with a forecasting tool, which means next year, what should be the return I have got? The example that we saw right now of last 10 years, and of which we got 15% as the central tendency. That 15% I had found out through arithmetic mean. And this is what a forecast is, that okay, most probably next year my return is going to be around 15%. This is what your arithmetic mean is. And now what is the harmonic mean? Harmonic mean is n multiplied by standard deviation of 1 by x, summation of standard deviation of 1 by x. So if there are, say for example, 5 values, then it is going to be 5 divided by 1 upon whichever one value is, plus 1 upon the other value, plus 1 upon the other value, plus 1 upon the other value, and there is 1 upon other value as well. Add all of them, all the 5 of them. This is how you calculate the harmonic mean. This is how you calculate the harmonic mean. And now coming to median and mode. Median is what? Arrange the data in ascending order, and then the midpoint of the data set is the median. Whichever the midpoint is. If, say for example, there are 100 items, what is the midpoint? The 50th item is the midpoint. So 50th item, whichever it is, you have anyways arranged in the ascending order, and therefore whichever is the 50th item, that is going to be the midpoint. That will be your median. And what is the mode? The value which occurs most number of times in the data set is known as the mode. So over here in the histogram, we see that 7 is actually coming, this 0 to 10% is coming 7 times. 7 times in your lifetime, the returns have been between 0 to 10%, and therefore I will say that the mode is 0 to 10% return. The mode is this, and therefore I will say that as per mode, the average is 0 to 10% average. Next year your return should be between 0 to 10%. I may fall right, because most of the time previously also 7 times the return has been between 0 to 4% only. This is what your mode is. So remember, mean is something that you are going to calculate, like arithmetic mean, geometric mean, or harmonic mean. Median and mode are simple. Median is the middle point, exactly the middle point, whatever the value is, the middle point is known as the median, and mode is whichever value occurs the most number of times, that is going to be the mode. This is your measures of central tendency. All of this is how to find out that 15% that we had got, right? In the previous example, I showed you 15%. This is how we are going to calculate 15% through either mean or median or mode. And within mean also, arithmetic mean, geometric mean, and harmonic mean. And within arithmetic mean also, we are having simple and weighted arithmetic mean. So we will start taking the questions as well. Okay, let's start. You have calculated the stock returns for AXZ Corporation over the last 5 years, and they are 25%, 34%, 19, 54, and 17%. Given this information, estimate the mean of the distribution of returns. Now we are going to use simple arithmetic mean. There is 19, 17%, 19%, 25%, 34%, and 54%. Just add all of them and divide by 5. What is the mean? Summation x divided by n. So summation of all the values divide by n, and you get the answer as 29.8%. This is the simple arithmetic mean that we have done. This is the simple arithmetic mean. They have asked for the central tendency mean. We'll be using simple arithmetic mean. Now next, coming to a portfolio consists of 50% is towards the stock, 40% is towards the bonds, and you have kept hard cash of 10%. The return is 12% on stocks, 7% on bonds, and obviously on cash it is going to be very, because it is liquid, returns would be only 3%. What is the portfolio return now? If they are asking portfolio return, over here we will be calculating weighted arithmetic mean. Weighted arithmetic mean is weight multiplied by the value summation of all of them. Now summation W into X. So what is the weight given to this? Out of total 100%, 0.5 weightage is given to this, 0.4 weightage is given to bonds, and 0.1 weightage is given to cash. So weight into value is going to give you 6%, 2.8%, and 0.3 percentage. The total comes to 9.1 percentage. So 9.1 percentage is the weighted arithmetic mean. This is the weighted arithmetic mean of the portfolio, that is what we are seeing. So for portfolio we will be using weighted arithmetic mean. Now next, coming to, for the last 3 years, the returns for Acme Corporation's common stock have been minus 9.34%, 23.45%, and 8.92%. Compute the compound annual rate of return over the period of next 3 years. This is what your return is. Now, if this is your past year return and the compound annual rate of return is what you have to find out, remember what are we going to do? We are going to find out geometric mean. So 9.34% negative return. So first, what are you having? If 100 minus 9.34, it comes to 90.66. So your returns are 0.9066. This is what your money becomes in the first year. Multiply by, in the second year, your money will be 1.2345. Remember, whenever there is a negative over here, like we are having in the first year, negative 3.4 percentage, this is what we are going to do. Minus 9.34, do that 100 minus 9.34, or 1 minus 0.0934, and you will get 0.9066. So we are going to do that for negative. For positive amount, it is very simple. The next one is 8.92%. So 1.0892. For 8.92%, don't take 1.892. It is 1.0892. Okay. Don't make this mistake. Sometimes people make this silly mistake. We don't have to make silly mistakes because we know the question, we know the answer, how to do it. Just because of silly mistake, we should not get a wrong answer. So this is what we are going to do for geometric mean. So 0.9066 into 1.2345 into 1.0892. So you got something as 1.2190. This y to the power x, open the bracket, 1 divide by 3, close the bracket, is equal to, you get 1.0682. Do minus 1, you get 0.0682, and then multiply by 100 and you get 6.8247, which is 6.825 percentage. This is what we have found out through geometric mean. This geometric mean is nothing but the average that you have got for the past 3 years. Okay, now we will be moving to the next one. An investor purchases $1,000 of mutual fund shares each month, and over the last 3 months the prices per share were $8, $9, and $10. What is the average cost per share? Now there are 3 shares. One share he has bought at $8. The second lot that he has bought is for $9, and the third lot that he has bought is for $10. What is the average cost per share? Use harmonic mean. What is the harmonic mean? N upon summation of 1 by x. So n is total 3 stocks that he, 3 times or 3 lots that he has bought. So 3 divided by 1 divided by 8 plus 1 divided by 9 plus 1 divided by 10. What is this? This is summation of 1 divided by x. X is nothing but 1, 2 and 3 values. So values we have used. So 3 divided by, so first you calculate this, 1 divided by 8 plus 1 divided by 9 plus 1 divided by 10. So you get something, and then do 1 divided by 8 is 0.125, 1 divided by 9 is 0.11, and 1 divided by 10 is 0.1. So summation of all is 0.3361. This is in the denominator, right? 0.3361 is in the denominator. Now 3 divided by 0.3361, how to do it? So 3 divided by 0.3361 is, on your calculator right now you are having 0.3361. Use 1 divided by x. So whatever you got is 1 divided by 0.3361. This is what you have already got on the calculator, that is 2.97, and then you do multiply by 3. So whatever you got multiply by 3, you get 8.9256, which is 8.93. 8.93 is the average cost per share. So you have average cost per share of 8.93%. Now remember, even if you would have found out you have invested $1,000, $1,000 and $1,000 each time, when the price of the share was 8, you had actually got how many shares? 125 shares. Then next time when the price was 9 in the market, you got 111 shares. And then when the share price in the market was 10, you got 100 shares. Total, you got 336.11 shares you got, and you have invested how much? 3000. So 3000 divided by 0.336.11 will definitely come to 8.93 only, which is the average cost per share. So this is what we simplistically did in harmonic mean, which is summation, which is n divided by summation 1 divided by x. So this is what your harmonic mean was. So we have done simple arithmetic mean, weighted arithmetic mean. So these two we did in mean, arithmetic mean. Then we did geometric mean and harmonic mean over here. Remember, when you do arithmetic mean, you are somehow giving a perspective of what the future return, the future year, the next year return is going to be. That average return is going to be found out through arithmetic mean somehow. That is the average return. When you do compounding and you come to whatever the past year's returns were, what is the average return that you have earned in the past few years, then we use the geometric mean. And over here we have been using harmonic mean. And how is harmonic mean coming up? When you want to find out the average cost of the shares that you have bought and so on. This is what your harmonic mean is. Now let us go a little bit more ahead. What is the median return for 6 portfolio managers with 10-year annualized total return record? Now there are 6 total portfolio manager. All of them have different returns. Arrange them in first ascending order. So the ascending order is 15, 21, 25. No, there is 23, 25 and 28 and then 30%. So all the 6 of them are in ascending order. Then you are wanting to find the median. What is the median? Median is exactly the midpoint. So exactly the midpoint is n plus 1 divided by 2. This is your exactly the midpoint. So there are total 6. 6 plus 1, 7 divided by 2 comes to 3.5. Which is the 3.51 to 3.5, something in between over here. So 23 plus 25 divided by 2 comes to 24. 24% is the median. So if I tell you what is the median return of the portfolio managers that are in front of you, the median return for them is 24%. So this is the median return that people are having in the market. Yeah, some of them are below, some of them are above, but which is the median one? The midpoint, exactly the midpoint, the center point, that is 24%. This is your median. And the next one that we are going to see, what is the mode of the following data set? Again, there are few people in the few portfolio managers in the market who would have gained some return over the past few years. This would be the average return. Maybe this would be the average of past 5 years, 5 years, 5 years, 5 years, whatever, however the average has come. But these are the different returns. These are the returns of different portfolio managers. Now, what is the mode if I ask you? Median would have been the center point. So first arrange them in ascending order, and whatever the number are over here, 1 2 3 4 5 6 7, 7 plus 1 8, 8 divided by 2, the fourth one. So 1 2 3 4. So whichever is the fourth one, first you will have to arrange it in the central, in the ascending order, and whichever is the fourth one, you will have to just pick up that, and that would be your median. But what are we finding right now? We are finding the mode. Mode is whichever has got the highest number, that is your mode. So 30 has come only once, 28 has come 2 times, 25 has come once, 23 has come once, 28, okay, it has come 2 times, 15 has come only once, 5 has also come only once. Okay, so 28 has come twice, and therefore that is the mode. So I'm going to say that mode is 28 percentage. This is what your mean, median and mode was. This is your measure of central tendency. Now moving ahead, the arithmetic mean, we have already done this, okay, I'm repeating it again. What arithmetic mean is only measure of central tendency for which the sum of the deviations from the mean is 0. I'm again repeating, keep this in your mind, it will be helpful some or the other point of time. The arithmetic mean is the only measure of central tendency for which the sum of the deviation from the mean is 0. In the previous example, when we were doing mean, we have seen in this sum, summation x minus x bar, what is it going to be? 17 minus 29.8. The next one is 19 minus 29.8, and so on you go till 54 minus 29.8. When you do addition of all the things that we have taken, all the 5 of them, it is going to add up to 0. This is what your arithmetic mean was, and when you add all of them, it comes to 0 only. This is what we are trying to say over here. The arithmetic mean is the only measure of central tendency. So what are the measures of central tendency? Mean, median, mode. Within mean also we are having arithmetic, geometric and harmonic mean. Now out of all of these different central tendency, it is only arithmetic mean in which we are going to find that the sum of the deviations from the mean is 0, which means summation x minus x bar is always going to be 0. Mean is always written as x bar. So remember, what is x bar? Summation x by n. This is how we had found out the arithmetic mean, a simple arithmetic mean. So this x minus x bar, each value 17 minus 29.8, 19 minus 29.8 and so on till 54 minus 29.8. When you add all of them, it comes to 0 only always. This is what we have to remember. The next one is, we always use geometric mean to calculate past few years compounded return. This is what we had seen in the example as well. And arithmetic mean is used as a best estimator for next year's return, right? We had seen that in the question as well. So if you want to forecast next year return, then what are you going to use? Use arithmetic mean. That is going to be the best estimator for the next year. Thus, arithmetic mean is always forward looking. So this is what we have done, the different measures of central tendency. Now we will move to quartiles. Again, quartiles is one of the method of central tendency. Somehow it is not giving you a center point, but whichever point that you want to calculate, it is going to help you to calculate that. So quartiles are when you divide it into 4 parts. We also say a quarter. First quarter, second quarter, third quarter, fourth quarter results, right? So quarter is 1/4 of a part. Quintiles is when you divide it into 5 parts, that will be quintiles. Deciles, we say a decade. A decade is what? 10 years is known as a decade, and percentage is 100, right? So deciles and percentiles, when you divide into 10 parts, it is known as deciles, and when you divide into 100 parts, it is known as percentiles. So very simple, we have in our day-to-day life, we use these words. Except for quintiles, we use many of them. We use quarter, we use decade, we use percentage or percent or something. So we know all of them. Now, how to find the above measures in the terms of quartiles or quintiles or deciles or percentiles? How are you going to calculate? N plus 1 into whichever y you are calculating, whatever you are calculating. Quartiles, it will be either 1/4, 2/4, 3/4 or 4/4, whatever you are calculating. Quintiles, it will be 1/5, 2/5, 3/5, 4/5. Percentile, it will be 52/100 percentile if we are calculating 52 percentage of something. So whatever, n plus 1 multiply by whatever you have got. So Let us take a question on this. What is the third quartile? Which means they are asking 3 by 4th. Third quartile. Quartile means something which is divided into 4 parts. That is known as quartile. They are asking third quartile, which means 3/4 they are asking you. Of what? Of the following distribution of returns. So these are the distribution of returns. We call this as a distribution of returns. Now, what are they? 8, 10, 12, 13, 15, 17, 17, 18, 20, 23. Remember, these are already in ascending order. So very good for us. You will have to first calculate into ascending order. First tell me what is the mode over here. It's very simple to calculate a mode. I can see 17 has come 2 times and no one else has come 2 times. And therefore 17% is the mode. Okay, I got a mode as well. Let me calculate what the median is. How many numbers are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 plus 1, 11. 11 divided by 2 is 5.5. So 1, 2, 3, 4, 5. This is 5. This is 6. Between them 16%. Okay. So median is 16%. If I was to ask what is the mean, then mean will be add all of them, summation of all of them, summation x divide by there are 10 of them, whatever comes over here, that is going to be simple arithmetic mean. Let us not calculate that, it is not asked over here. What have they asked us? They have asked us what is the third quartile. So third quartile is going to be, there are 10, n is 10 plus 1 which is 11, it comes to 11 into 3 divided by 4 because they have asked third quartile. So 11 into 3 divided by 4 gives you 8.25 is the third quartile. So 1, 2, 3, 4, 5, 6, 7, 8. This is 8th one. This is the 9th one. And you want the 8.25. 8.25. So 8.25, 18% anyways you are having. Then the difference is how much? 2. You want 0.25 of this 2. So 0.25 of this 2 is what? That is 0.5. So 18.5% is the third quartile. This is the third quartile. This is how you calculate third quartile. And midpoint would also be just, you will have to take second quartile would be 2 by 4. First quartile would be 1 by 4. 51st quartile would 51st percentile would be 51 by 100, and accordingly it would come somewhere between this. This is how you need to calculate different things. This is what your quartiles are. Now moving something to measures of dispersion, which means you have calculated a central tendency. Through central tendency we found out that okay, 18.5 is coming, or say for example whatever you have found out, 28% as the central tendency over here. Over here 24% we had found out as a central tendency. Over here we had found out 8.93. So different central tendencies we have found out. Now in reality, next year when we reach in the next year, we have found out a central tendency, but not necessary that the central tendency would be true, right? This is out of past data that we have calculated central tendency. But in reality there is going to be a range. Maybe say for example this is what is the measure of dispersion is. So we are going to find out what is the measure of dispersion, how much is the deviation that may happen in future is what we are going to find out, because no one has seen future till now, right? We just know as of today what is going on. We don't know what is going to happen in future, and therefore once you have calculated a central tendency, you also need to give you how much deviation may happen. Now even that may not be true, okay, but we are giving a best estimate of what the deviation may happen based on again past data only, that okay, in past deviation was this much. Say for example central tendency you had found out 15%. In the past the deviation was of say for example 10% on both the sides. So 5% to 25% the return can be. This is the deviation. Or in the terms of standard deviation you may speak up that there may be a 4 standard deviation on both the sides. So it can be either 4 standard deviation below 15% and 4 standard deviation above 15%. This can also be your deviation. How have you come at this particular rate? Obviously, based on past data, we came to know. In reality, it can be anything. Okay, we can get 100% return also one fine day. If, say, for example, next year is very good, I pick up very good stocks. As soon as I sell a particular stock, the market crashes, the stock price crashes. Or once I buy the particular stock, immediately the next moment the stock price rises. I am very lucky for that matter. I am fortunate enough. And for that year, my returns were, say, for example, 100%, 200%, whatever. I am so much lucky. Now, the deviation that I had given was only 4 standard deviation, or the range that I had given was only between 5% to 25%. But in reality, it can be 100% also. So, there is no fixed rule that the return that you get next year would be within this range only, or within this whatever the deviation that we have said. But with a major like if there is no major deviation, we know with a reasonable probability that it will be between this range only, like between 5% to 25%. What else would happen? It would be either 10% or 11% or 14% or 17% or 18% or 20%. Now, in a worst to worst case scenario, it may move to 5%, or in a best to best case scenario, it may move to 25%. Like this can be the maximum range. That is with a 99% probability that I can tell you. Still 1% I am keeping it aside because it can be either minus or it can be 100% positive, whatever can happen. But the chances are very low. This deviation that I am doing from 15% is known as measures of dispersion. And now we are going to learn different measures of dispersion. First one is the range. Very simple. Whatever in the past you have got the maximum value and the minimum value, that range is going to be called as your range, which is your measure of dispersion. So that is the first one that we have found out. Mean absolute deviation, MAD, MAD. So what is MAD? MAD is MAD. So mean absolute deviation is summation of x minus x bar divided by n. So in the previous sum that we had seen, 17 minus 29.8. So add that. Okay, only the positive values. Okay, so only the positive values. 17 minus 29.8 is actually minus 12.8, but we will not be taking minus because this is like this over here. When we do like this, it means that minus goes away. You only have to take positive values. So summation of this is 12.8. Then the next one was 19. You can go back and see the video. Okay, you can go back and see the video. I know what it is. The next one was 19 minus 29.8. That is going to give you 19 minus 20.9.8 gives you 10.8. Okay, but the positive amount. And then there were two more figures, and then the last one was 54 minus 29.8. 54 minus 29.8 is going to give you 24.2. Again a positive amount. All of them, summation x minus x bar. If you put this as minus and some things, remember we had seen summation of all these things, summation x minus x bar is going to be 0. But what we are doing is, here we are taking this negative value also as positive, and when you do addition of all of them, whatever the amount comes, divide by 5 is going to give you mean absolute deviation. Like this is how much it is moving ahead, or it is moving, deviating from 29.8, which is our mean that we have calculated. This is your mean absolute deviation. Fine. We will be taking some on all of these. Okay, so don't worry. Now we're coming to standard deviation and variance. The calculation for both of them is given out over here. So listen to me right now. How are we going to say variance? Variance is this. And when you take a root of this thing, so first you are squaring and then you are taking a square root, which means it comes to standard deviation. That is this particular thing only. So this is how we denote. Variance is this particular thing is known as variance. And when you take whatever the answer it is coming, say for example, variance is coming as 16. So what is the square root of that? 4. 4 is your standard deviation. So very simplistically, we denote standard deviation as like this and variance as square of this. This is what your standard deviation and variance is. How are we going to calculate? So first coming to variance, because square root of that is your standard deviation. So let us just see this variance part. Whatever the variance is, you just have to take a square root of that and you get the standard deviation. Or if say for example you are taking the standard deviation, just do square of that and you come to the variance. So let us see what the variance and standard deviation is. Population variance. Population variance is summation x minus mu by n. Summation x minus mu square by n. This is what your variance is. Remember over here what mu over here. This is known as mu. Okay. This is your mu. Mu is nothing but your mean only. The mean that you had calculated, summation x divided by n. This is the mean. Now, if say for example you have used population data, summation of x means if say for example it is BSE or all the stocks on Bombay Stock Exchange or all the stocks on New York Stock Exchange, all the 5,000 stocks, okay? When you have done summation of all those 5,000 stocks, divide by 5,000, that is your population mean. If you are using this population mean, then we will be denoting it as a mu. We will be denoting it as a mu. Why are we saying this mu? So that you can understand, so that whoever the users are, we all can understand that, okay, I have used population as the base. And therefore, the answer is the same. The method is the same of calculating mean, summation x divided by n. But how many stocks I have used? I have used all the 5,000 stocks. And therefore, summation x by n, all the 5,000 that I have used over here as the data, I will be calling it as a mu, M-E-W. This is the mu, right? And therefore, this is what your answer is going to be. So, summation x minus mu square divided by n, this is your population variance. Now, instead of population variance, if you are using the sample variance, so instead of this, we will be using s square. Just the different things we are using, the denotation is different, and the formula for that is summation x minus, here we will be using x bar. What is x bar? If say for example you are using Dow Jones or you are using Nifty or you are using Sensex, there would be 30 stocks, 50 stocks in this index. Dow Jones, Nifty, there will be 50 stocks. Sensex, there would be 30 stocks, right? This is just a sample. We are not talking about all the 5,000 stocks in the stock market. We are talking of only the 50 or 30 stocks. And therefore, when you do summation x of all those 30 stocks or 50 stocks, divide by 30 or 50, whichever that n you have taken, summation x by n, whatever you are taken, that summation x by n that you have got is known as x bar. The formula was same for population also, mean, and in sample mean also. Just the thing is we will be using it as x bar or mu. When summation x by n that you have done for all the 5,000 stock, that mean will be known as this particular thing. We will be denoting it by this particular thing. And if say for example it is for a sample, then we will be using x bar only. This is what your total sample variance is going to be. Remember, in sample variance, the denominator that you take is going to be n minus 1. Okay, remember once again, I am highlighting you again, n minus 1. What are we going to take? N minus 1. If say for example there are 30 stocks that are there in the stock market index, if there are 30 stocks that you have taken in the numerator, summation x minus x bar square, then you will have to do divide by 29, because that is 30 minus 1, 29 is what you are going to take. Again, I am going to repeat, there is a reason behind this. Always for a sample we are going to use 30 minus 1, which is 29. This minus 1 is going to increase the sample variance, increase the sample deviation. Remember, whatever the population is there and whatever the sample is there, the sample, whenever you are decreasing something in the denominator, the variance or the standard deviation that you get, that is going to be increased, because instead of divide by 30, now you are going to do divide by 29. Or if there are 50 stocks that you have taken, divide by 50, instead of that you are doing divide by 49. So the deviation that you get is going to be increased when you are calculating it for a sample. Population variance and sample variance that you have got, when you do square root of that. This whole thing, you do square root of that and you get sample standard deviation. You do square root of this population variance, you get population standard deviation. So variance gets converted into standard deviation if you do a square root of the variance. So square root of variance is your standard deviation. Again, what are you going to use over here? You will be using this, and over here you will be using this. Over here you will be using just this. Over here you will be using just this. So this is your standard deviation. This is also your standard deviation. The only thing is this is population standard deviation and this is sample standard deviation. This is your population variance and this is your sample variance. Remember, when it comes to sample, there will be n minus 1 over here in the denominator. And when it relates to population, we will be using this particular thing. Well, how has this come? This has come from summation x divided by n only. The only thing is there are going to be 5,000 items over here. You will have to calculate the sum of all the 5,000 and then you will have to do divide by 5,000. And in sample, we will be using x bar. What is x bar? X bar again is summation x by n only. The only thing is summation x will be only the 30 or 50 stocks, the sample that you have taken. Summation of those 50 values only, divide by 50 you will be doing. This will be your x bar. Fine. This is what your standard deviation and variance is. Again, because this is important, first we calculated central tendency. From the central tendency, we are seeing how much is the dispersion that is happening, how much is the deviation that is happening from the central tendency that you have taken. So the dispersion or the deviation that is happening is going to be calculated over here. Range and mean absolute deviation is there, which is simple. Then coming to standard deviation and variance. Both actually are one and the same only. The only thing is when you do square root of variance, you get the standard deviation. So let us just focus on one thing, say for example on variance. Now square root of variance is going to be your standard deviation. So that is pretty simple. We don't have to think the formulas, nothing changed. All the formulas are same only. Just do the square root of variance and you get standard deviation. So let us just understand one formula of variance. Now if it is population variance, it is summation x minus this particular mu divide the square divide by n. And if it is sample variance, it is summation x minus x bar square divided by n minus 1. This is your total measures of dispersion. Fine. Understanding what the measure of dispersion is. Now next coming to the question. Below is the 3-year annualized return of 5 investment managers. Now you have been given 30%, 12%, 25%, 20% and 23%. 5 investment managers, 3 years annualized return is given. How this 30%, how he would have calculated? For that one particular manager, in first year there would be some return, say for example 35%, 1 year there would be 30% return and the other year 25% return would be there. Simple arithmetic mean would have come to 30%. This is their 3-year annualized return. So somehow they would have done some measure of central tendency and that one manager's return came to 30%, then 12%, 25%, 20%, 23%. Right? This is how it is. So you have calculated this measure of central tendency for all the 5 investment managers. Now you want to calculate what is the measure of dispersion. Now these 5 managers amongst themselves, if I see what is the dispersion or the deviation that is happening amongst those 5 people. So now amongst these 5 people we can find average as well. Summation x by n. Summation x by n. So just do 30 plus 12 plus 25 plus 20 plus 23 divide by 5. This is the normal arithmetic mean. This is what a 6th manager would be finding out. This is the central tendency. Measure of central tendency by arithmetic mean is what? Say for example, this comes to, just as an example, it comes to 21%. So if I add a 6th manager in along with these 5, the 6th manager would be having 21%. But this is just a measure of central tendency. Arithmetic mean, normal arithmetic mean. Now if I want to say that it is not necessary that the 6th manager that I bring from the market, he would be earning 21%. This is just the measure of central tendency, the mean that I have got, or median or mode that I would have found out. If there would be someone having this person having exact 20%, then the mode would be 20%. Then I would say the sixth person who is coming would also be having 20% return. But that's not true, right? If, say, for example, 21% is the average return, the return that we have got for the sixth manager, okay, we don't know, okay, what the in reality sixth manager has not yet come in, but we are just thinking, if at all a sixth person comes in, a sixth investment manager comes in, what would be his return? His return would be, what would we do? We just calculated the average return, arithmetic mean, and we came to 21%. Now we want to find out, in reality, what would be his dispersion? In reality, he would not get exactly 21% return, right? He would get something else. What would that be? What is the deviation that would happen? This is what we are going to find out. We would say that his return, we have seen the central tendency at 21%. But in reality, see, there was some manager who could also take 30% return. Now, if the sixth person who is coming is smarter than that first person, he would also have 35% return. We don't know. Or he is very bad at investment decisions, or he is unlucky or unfortunate. We don't know. Even if he is good at investment decision taking, but he, say, for example, he got unlucky this particular year or in this past 3 years, whatever it is, and he could get a return which is less than 12% also. It would be possible, right? So now, even though I found the central tendency at 21%, I want to find out what the range is, or what the dispersion is, the deviation is. This is what I want to now find out. So that is your measure of deviation or measure of dispersion that we are going to do. Range, mean absolute deviation, population variance and standard deviation. And if, say, for example, this is not a population, this is just a sample. In the market, there are hundreds of investment manager. This is just a sample that I have taken. So what is the sample variance and standard deviation we want to find out? So this is your measure of deviation that we are going to find out. Okay. In reality, whatever will happen is a different thing, but measure of deviation, if, say, for example, range is 12% to 30% is the range. This is what others in the market have also done. This person, investment manager number 1 had got 30%, 2 had got 12%, third one got 25%, fourth one got 20%, fifth one got 23%. So your range is, the highest is 30%, the lowest is 12%, and between them, that is what your range is. And this is what you got 21% also as. This is your range, highest and the lowest one. Fine. So this is your range. I hope you all are understanding what we have been doing in measures of central tendency, measures of dispersion. Well, if you read through the book, in the book it won't be explained in such a simple manner. Okay. So when you go through the book, whichever book that you are referring, it will be very difficult for you all to understand unless you are from some science background and you would have done all of these things. Otherwise, this is going to be very difficult for you. So I have just explained in a very simple manner. When I was in my CFA level 1 giving the exam, the whatever that I have been saying right now, it was not so much clear in my mind, the way I have been teaching you all. So you are at a better position than me. And if I could pass the exam at first go with this kind of a knowledge, I am sure if I am giving you this knowledge which I did not have at that point of time, you should also technically pass the examination at first go. So obviously, I'm going to help you the most. Wherever you are getting stuck, do reach out to me. For me, what my goal, my motto is that you all should pass. This is the motto of Infinity Concepts as well. And therefore, you should do the best in the examination and pass is the only motto. So, okay, let me just go ahead. Let's find out what the range is. Range is whichever the highest one is 30% minus 12%, which is the lowest one, it comes to 18%. This is the range. 30% and 12%, high maximum minus lowest one gives you 18% as the range. The next one they had asked was your mean. If this is the population, there are only 5 managers in the market. There is not even a single manager more or less in the market. Like this is what the population is. Then we will call this as mu. If, say, for example, this is a sample and this is not a population, in the market there are hundreds of investment manager. We just picked up these 5 people, which is what we are seeing over here, only these 5 people, and therefore what we will be writing over here is x bar. However, whatever we are writing, whether mu or x bar, whatever we are writing, this is just to understand whether this is relating to population or it relates to sample. But what we are seeing over here, the formula that is going to remain the same, summation x divided by n. So 30 plus 12 plus 25 plus 20 plus 23 divided by 5 gives us 22%. This is your mean. Now coming to mean absolute deviation. Mean absolute deviation, summation x minus x bar. You will have to make it positive, okay, always. Divide by n. Summation x minus x bar. So your mean has come to 22%. So 30 minus 22% plus 12 minus 22% plus 25 minus 22%. Okay, don't put negative over here of minus 10. Okay, you will have to take it as plus 10 only. All divide by 5, which is what your 4.8% is. So 4.8% is mean absolute deviation. You got a mean of 22%. You have got a range of 30 to 12, means 18% plus and minus is what is going to happen in reality, is what we are trying to say. The range is 18% between which they are going to go. Mean absolute deviation is 4.8%, which means if you are adding a sixth manager also, what is going to be the sixth manager's mean absolute deviation? So mean is 22%, and these, if the whatever these five investment managers or the next one, the sixth one that you add, the mean absolute deviation is 4.8% plus or minus from 22%. This is what we are trying to say. Okay, in reality it can be anything, but we are trying to say that most probably what is going to happen is the new person that is coming is 22% plus minus 4.8 percentage further. This is what your mean absolute deviation is. Now coming to population standard deviation and variance and the sample standard deviation and variance. So what is your population and sample standard deviation variance? Remember, whatever that we are using, if it is relating to population, we call it as a population parameter. And whatever we use something related to sample, that will be known as sample statistic. So if we are finding out population variance, that will be called as a population parameter. If we find sample standard deviation, that will be a sample statistic. So this is the word that we use. So remember all of these words. Whatever I have been saying, you can just note down at one particular point of time. I am repeating it many times, so you can just write down just once, but then you will have to remember. If someone is not writing it down at one place, and therefore I am using it and repeating it again and again, because this is what needs to go in your head. And remember, what I'm teaching right now, I'm teaching in such a manner that you don't have to go home and practice from another book or somewhere. And you don't have to read it again and again. This is what our motto is. No doubt you'll have to go home and do revision again. That is required for confidence building. But if somehow, even if you don't do it, then this video should be enough. And therefore, I am repeating stuffs again and again wherever importance is there. If it is not important, I won't repeat it as well. This is important, and that's why I'm repeating it again and again, so that it flows into your mind directly. Okay, let us see what population parameter is. I want to find out the population variance and standard deviation. So first let us do population variance. Square root of that is going to be population standard deviation. So first calculate what the mu is. The mu is 30 plus 12 plus 25 plus 20 plus 23 divided by 5. It comes to 22%, which is what the mean that we had already calculated. That divide by 5 is 22% that we have already got. Now variance. Variance is summation x minus x bar, whatever you get, positive amount of that, and then square. So 30 minus 22, whatever you get, 8, square of that. So 8 8s are 64. So over here will be 64. Then the next will be 12 minus 22 is minus 10. But you have to take a positive amount only. So 10. 10 square is 100. So add that 100. Then over here there will be 3 square 9. Then over here there will be 2 square 4. And then over here will be 1 square 1. So everything 164, 174, 178 divide by 5. It comes to 35.6 percentage square, right? So this is your 35.6 percentage square. This is your population variance. This is your population variance, and your population standard deviation is going to be 35.6 percentage squares square root, and therefore this comes to 35.6 square root is 5.97. 5.97 percentage is your standard deviation. This is your measure of central tendency. The mean that you found out was 22%. 22% is measure of central tendency, and how much you are deviating from that. For that we found out population variance and population standard deviation. This is what your population variance and standard deviation is. Now coming to sample variance and sample standard deviation. Sample variance we will be writing it as like this, and sample standard deviation we will be writing it as like this. The mean we will be writing over here like this, and over here the mean that we had written was like this. This is what you use it for population and sample, right? You should know this. So x bar is again 22%, which is same. Standard deviation and variance for sample will be having a denominator of 5 minus 1, and same thing, 5 minus 1 we will be using. This is going to be same, 178 divided by 4. Now 178 divided by 4 is 44.5 percentage square is your sample variance, and your sample standard deviation is 44.4 percentage square root of that, it comes to S, which is your sample standard deviation. So this was pretty difficult part that we did. In the initial portion we felt that, oh my god, so many things are there, but now we don't feel so much difficult, right? Because it is simple. You just have to understand the whole concept. This is what your different population parameters and sample statistics were. Now we will move to the next one, which is Chebyshev's inequality. What is Chebyshev's inequality? Topic which is not very much related to the past what we have been doing. Chebyshev's inequality. Chebyshev's inequality calculates percentage of observations that lie within k standard deviation of the mean. If say for example mean that you have found out in the previous example, mean that we have found out was 22%. How much standard deviation it is from the mean? Say for example 22% is the mean that you have found out. How many standard deviation it is away from the mean? This side and this side. So say for example this is 3 standard deviation away, 4 standard deviation away. How much is that? This is what we are trying to find out over here. So the formula for Chebyshev's inequality is 1 minus 1 divided by k square. So if I want to find out 2 standard deviation, so 2 standard deviation is 1 minus 1 by 2 square comes to 1 minus 1 by 4, which comes to 0.75, which is known as 75%. So we say that 75% of the sample or the population or the data that you or the value that you have calculated, 75% of the calculated values will be within 2 standard deviation of the mean. If say for example you have 4 standard deviations, okay, so 22% and 4 standard deviation will be further over here till here. So you are giving a wider range. You are not very much sure. If say for example I give you a standard deviation of just 0.25. So if 22% someone is calculating, 0.25 standard deviation is just this much. So you have given a range of very small range to someone, which means you are so sure that the other person, the other investment manager that you are calling will have a return between a very small range, say for example from 20% to 24%, just as an example. And if you give someone a range of very high range, you are giving 4 standard deviation, which means you are not at all confident that he will be gaining 22%. You are saying that his range is going to be from minus 5% to plus 20 plus 35%. This is what the range that you have given, because you are not sure on that person in investment manager. He can either go into a negative or it can go positive. This is say for example 5 standard deviation apart on both the side. minus 5 standard deviation this side and plus 5 standard deviation this side. So now with a lot of confidence you can say that 99.9% of the times this particular person is going to be right, because you have given only such a wide range. Obviously that person will have to fall in this particular range, right? So if say for example you are having 4 standard deviation, so 1 minus 1 by 4 square, it comes to 94% or 0.94, which means 94% of the observations are going to lie between plus and minus 4 standard deviation. Obviously when you have got a standard one central tendency and you give 4 standard deviation on both the sides, such a huge standard deviation, such a huge range, obviously most of them are going to fall within this range only, right? 94% of the people will fall in that range. If you give a small standard deviation, a smaller range, then lesser number of people are going to fit in that particular thing. In 1.25 standard deviation, see, only 36% of the people are fitting, or observations are getting fitted over there. Whatever it is, this is what Chebyshev's inequality is. Chebyshev's inequality calculates the observations that will lie within k standard deviations of the mean. So with confidence you can with confidence say that 94% of observations will lie within 4 standard deviations. So 22% is over here, 22% on one side is minus 5%, on the other side is 35%. We say that 94% is my confidence that the return is going to be between minus 5% to 35%. Fine. So this is what Chebyshev's inequality is relative